Hello, Tina Mitchell here with your Monday market update on December 9th. Last week, mortgage rates decreased to their lowest level in over a month. Despite just a modest drop in rates, consumers clearly have responded as purchase demand noticeably improved. The responsiveness of prospective home buyers to even small changes in rates illustrates the affordability headwinds persist. Mortgage rates may decline next year, but not by much. The 30-year fixed rate is expected to stay in the mid 6% range throughout 2025 and 2026, although the forecast is far from guaranteed. In January of 2023, some analysts thought that the rates would be around 4.5% by the end of 2024, which obviously did not happen. The November housing forecast from Fannie Mae puts the average 30-year fixed rate at 6.5% in the beginning of 2025, declining to 6.1% in the second quarter of 2026. Fannie Mae economists say that this month's forecast update didn't take into account any policy changes that might happen as a result of the presidential election. The Mortgage Banker Association predicts that its November mortgage finance forecasts that mortgage rates will gradually slide from 6.6% at the beginning of 2025 to 6.3% throughout 2026. Unlike Fannie Mae, MBA does point to the presidential election as a reason for its upward revision this month. The National Association of Home Builders expect the 30-year fixed rate mortgage to decrease to around 6.5% by the end of 2024 and fall below 6% by the end of 2025, according to the group's November outlook. The 2025 housing forecast from Realtor.com calls for another year of strained housing affordability and high mortgage interest rates. The real estate listing website predicts rates will average 6.3% in 2025, following ever so slightly to 6.2% by the year end. The 30-year fixed rate is now expected to stay elevated between 6% and 6.5% for the next 2 years. Just weeks ago, economists thought that it would fall to the 5% range by the second half of 2025. With such wild fluctuation in the forecast, you'd be just as likely to get a satisfactory mortgage rate outlook from a magic 8 ball. I cannot predict now, so you'll have to come back and ask me later. This week's interest rate update disclosure: there are many different factors that determine interest rate. Each week I share the national average, which is based on a conventional conforming 30-year fixed rate mortgage. Today, the national average is at 6.79%. This is assuming a 20% down payment and in the highest credit score bracket. How Fed rate cuts impact mortgages. While it might seem counterintuitive, as I've stated in previous mortgage market update videos, mortgage rates have actually risen since the Federal Open Market Committee began cutting the federal funds rate. Mortgage rates fluctuate for a number of reasons: economic conditions, investor demand, and Federal Reserve policy, to name a few. It's not a one-to-one relationship between the federal funds rate and mortgage interest rates. The 30-year fixed rate is directly tied to how the Fannie Mae 30-year bond is trading. Mortgage interest rates have bounced up and down over the past several months, with the 30-year fixed rate going from 7% in May to the low 6% range by September before reversing course to nearly 7% again in October, and now we're seeing them decline. Over the past few years, analysts have been predicting lower mortgage rates because the U.S. economy was expected to fall into a recession. But the fundamentals of our economy, like employment and GDP growth, are outpacing expectations, resulting in higher long-term interest rates. Still, the Fed has made progress towards its dual mandate of stable prices and maximizing employment, giving officials the confidence to cut the Fed's fund rate. The FOMC voted to cut the benchmark by 50 basis points, or a 0.5% point in its September meeting, followed by a 1/4 point cut in November. The Fed rate cut themselves should not have an oversized impact on long-term fixed mortgage rates, but they will affect consumers who have adjustable rate mortgages and variable rates on home equity line of credit. Advice for buyers in 2025. What buyers should know: waiting for lower rates comes at a price. Good things may come to those who wait, but patience doesn't always pay off in the housing market. Two-thirds of home buyers are waiting for mortgage rates to fall this year before buying a home. This is according to a March U.S. News survey. The vast majority of them, 85%, wanted to see the rates below 6% before entering the housing market, which hasn't happened. And it is not expected to happen in the near future. In the time that home buyers have been holding out for lower rates, home values have continued to rise. Home prices have appreciated by more than 15% since the beginning of 2022, according to the S&P CoreLogic Case-Shiller House Price Index, despite mortgage rates doubling in that time frame. Call to action if you find a home that you want to purchase in the area of the market that you're looking in. Now is the time to take action. And that is your Monday Market Update. Tina Mitchell, making a difference in families, one mortgage at a time.